Here's a question worth sitting with for a second. What if the responsible thing, the thing every finance guru on the internet tells you to do, saving up a full 20% deposit before you buy, is actually the thing costing you the most money? That sounds backwards. Saving more, being patient, avoiding debt, that's supposed to be the smart move. But stick with me, because two blokes are about to test that theory with real money, and the answer isn't what you'd expect. Meet Liam and Ethan. They're both 28, they live in the same mid-sized Australian city, they both earn $90,000 a year. Same job stability, same spending habits, same goal. They both want to own a home. Liam does what he's always been told to do. He decides to save the full 20% deposit before he buys anything. No shortcuts, no risk, do it properly. Ethan does something different. He uses the government's 5% deposit scheme, the one that, as of a recent expansion, has no income caps, no waiting list, and no lender's mortgage insurance. He buys almost straight away, with a much smaller deposit and a much bigger loan. Same income, same starting point, two completely different paths into the property market. Let's follow both of them for 20 years and find out who actually comes out ahead. The home they're both eyeing is a modest 3-bedroom place in a mid-sized regional city. Nothing flashy, just a solid first home. It's priced at $500,000. Under the old rules, buying this place properly meant saving a 20% deposit, $100,000, plus enough left over for stamp duty, conveyancing, and all the usual fees. That's the path Liam chooses. Ethan takes the other option. Under the expanded 5% deposit scheme, he only needs a deposit of $25,000. Because the government guarantees part of the loan to the bank, he skips lender's mortgage insurance entirely, a cost that on a loan this size could easily have run into the tens of thousands of dollars on its own. Both of them save at roughly the same rate, about $1,500 a month, and this is where their paths split completely. Ethan reaches his $25,000 deposit in under 2 years. By year 2, he's signing the paperwork. His loan comes in at $475,000. That's 95% of the purchase price. At an interest rate of 6.5% over 30 years, his monthly repayment lands at roughly $3,000. That's a genuinely big chunk of his pay packet. There's no pretending otherwise. But the banks assessed him as able to service it, and he's in. No lender's mortgage insurance, no years spent renting and watching prices climb. He owns the place in year 2 at $500,000.
Liam's plan looks solid on paper. Save $1,500 a month, hit $100,000 in about 5.5 years, buy with confidence and a healthy equity buffer. Except there's a problem nobody warned him about. While Liam is saving, the property he wants isn't sitting still. It's appreciating at roughly 5% a year, same as the broader market, which means the 20% deposit he needs isn't a fixed number, it's a moving target that grows every single year he doesn't buy. By year 1, he saved $18,000, but the target's already crept up to $105,000. By year 3, he saved $54,000, but the goalposts have moved to almost $116,000. He's working hard and somehow falling further behind. It isn't until year 9 years of renting, budgeting, and watching a number that keeps outrunning him, that Liam finally closes the gap. By then, the house that started at $500,000 is worth roughly $775,000. His 20% deposit is now about $155,000, and his loan comes in at $620,000, despite Liam putting down 4 times the deposit percentage. That's the part nobody tells you about saving for a safe deposit in a rising market. Playing it safe doesn't mean standing still. It means running on a treadmill that speeds up the longer you stay on it. At year 9, Ethan has owned his home for 18 years. At 5% average annual growth, his $500,000 purchase is now worth roughly $1,203,000. His loan, after 18 years of repayments, has fallen to around $295,000. That leaves him with approximately $908,000 in home equity. Liam has owned his home for 11 years, having bought later at the higher price of $775,000. With the same 5% growth, that property is now worth roughly $1,327,000. His loan has fallen to around $505,000, leaving him with approximately $822,000 in equity. So after 20 years, Ethan, the bloke who jumped in early with just a 5% deposit and a much bigger loan, ends up with roughly $86,000 more in equity than Liam, the bloke who did everything properly. The gap isn't enormous, but it's real, and it flows entirely from one decision: getting into the market 9 years sooner and letting 9 extra years of growth work in his favor. Now, before this turns into just use the 5% scheme and get rich, slow down. Ethan's path came with real risk that Liam never had to carry. When Ethan bought, his equity buffer was just 5%. If property prices had dropped by even 5% in his first year, which absolutely happens, markets don't only go up, he would have been in negative equity almost immediately, owing more than the house was worth. Liam, with his 20% buffer, was insulated from exactly that scenario. Ethan's repayments were also considerably higher for those first several years because he was borrowing 95% of a smaller home instead of 80% of a slightly larger one. If interest rates had climbed sharply early on, which they can and have, Ethan would have felt that pain far more acutely than someone with a smaller loan relative to their income. And there's a broader question worth raising too. Treasury's own modelling on the expanded scheme suggested it could add somewhere in the order of 0.5% to national home prices over 6 years, simply because more buyers are chasing the same homes with the ability to enter sooner. That's not a reason to avoid the scheme personally, but it's part of the honest picture. So what's the real lesson from Liam and Ethan? It isn't small deposits are always better. It's that time in the market, in a market that's consistently rising, tends to matter more than the size of the deposit you walk in with. Every year Liam spent saving for a bigger, safer deposit was also a year the market moved further away from him, and a year he spent paying rent instead of paying down a mortgage. But the 5% scheme isn't free of trade-offs either. A smaller deposit means a bigger loan, bigger repayments, a thinner buffer against falling prices, and far more sensitivity to interest rate rises. It's not risk-free early access, it's trading one kind of risk for another. The scheme also comes with real conditions worth knowing. It's limited to first home buyers or people who haven't owned property in Australia in the past 10 years, and there are property price caps that vary depending on where you live. It's not unlimited access to any home anywhere. Liam traded time for safety. He entered the market later, but with a bigger buffer and less exposure if things had gone wrong early on. Ethan traded safety for time. He got in 9 years sooner, took on more risk in the process, and, in this scenario at least, that risk paid off. Neither approach was foolish. Neither was guaranteed to work out the way it did here. If prices had fallen instead of risen over those first few years, this entire story flips, and Ethan is the one explaining to his mates why he's underwater on his mortgage. That's really the heart of it. The 5% deposit scheme doesn't make home ownership risk-free. It just moves the risk earlier in exchange for moving the reward earlier too. Whether that trade makes sense for you depends on how comfortable you are carrying a bigger loan, how stable your income is, and how much runway you've genuinely got before you'd need to sell in a hurry. If this kind of breakdown helps you think through your own next move, hit subscribe for more videos unpacking the logic behind the everyday money decisions Australians are actually making right now. And let me know in the comments, would you take the 5% scheme and get in early, or save the full deposit and sleep easier at night? See you in the next one.